stabilize, and or we're going to get used to whatever interest rates are. And if interest rates are permanently at the level they're at now, pricing is going to ultimately have to come in line to that interest rate reality, and we can get a better basis. So, I think if I were to be predicting when our next multifamily investment is going to be, it's definitely not going to be in 24. It could be in 25 if I find this needle in the haystack. But 26 might be looking a little bit more promising. I think maybe 26 and 27 might be when we start to see this turn around.
Cool. Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, and today we're joined with Brian Burke. Brian's a president and CEO of Praxis Capital, has 35 years in real estate, acquiring over $800 million in assets, 4,000 plus multifamily units, and authoring The Hands-Off Investor. Today we're talking about real estate syndications and if they're alive or dead. Brian, first, if you could give us some background on you and how you got started in real estate and how you essentially got to where you're over 4,000 units now.
Yeah, well, it's great to be here, Josh. Thanks for inviting me. I started investing in real estate 35 years ago as a small-time house flipper, and I grew that business over, a decade or so. And then about 20 years ago, got into multifamily. It was a 1031 exchange from a couple of rental houses I owned when I bought an apartment complex, playing Monopoly, right? You trade in 4 houses for one hotel. And I did that in real life, and that was my intro to owning and managing apartment buildings. That building was in California, and then the real estate market started collapsing in 2005, and realizing that it made no sense to buy real estate in California in 04, 05, 06. I started looking out of state and ended up buying apartments in New York, and then bought apartments in Texas. And that was kind of the start of really growing this portfolio. And then, ever since, it was just an exercise of buying, renovating, and selling and growing at the same time. So it's been a bit of a long road to get here.
That's well, and along the road, you've probably had you have to have mind shifts. You have to keep on leveling up. So what were some, I guess, growing points to where you wanted to get into more real estate, but you had to figure out how to get into multifamily, because there's always the levels of achievement.
There are. And, I always explain real estate investing as kind of like a meandering stream in a meadow. And if you're in a rowboat and all you know how to do is paddle straight ahead, you're eventually going to run aground. So you have to learn how to turn as the current and the stream meanders through this meadow. And when one strategy isn't working, you find another strategy. And then when that strategy stops working, which it eventually will, you find another strategy. And, real estate allows you to do that. That's how I went from flipping houses to buying houses as rentals to back to flipping houses and then, into multifamily. And multifamily is a great business because not only is it scalable, but there's also a lot of different ways you can play it. And you can shift where you're buying, because maybe some geographical markets aren't working today while others are. So you can move around the country. It's a large enough scale that it allows you to do that. But there's also different strategies within multifamily. You could build from the ground up. You could buy and hold. You can buy, fix up, renovate, and quickly resell. There's a lot of different ways to play the market. And what you have to do is figure out what's working today and where, and, make, as I like to say, you make the right investment in the right place at the right time.
Would you say that the flipping the houses and starting small, did that help you? Did that help build equity in order to get into multifamily? Was that a strategy, or was that a part of the plan?
It was really part of the plan. For me, when I got started in this business, I didn't know anything. I didn't have any money. I didn't know anybody that had money. So, you start where you can. You always have to. One thing about real estate, there's a lot of people out there that will encourage you, go big as fast as you can. Don't bother starting small. And I believe you just have to start where you are. And when I was 20 years old and getting into this business, that's where I was. There was no way I was going to be in the multifamily space, because first of all, I didn't know anything about multifamily. Second of all, I didn't have the money to get into multifamily. And third, I didn't know anybody that could have funded it. And even if I did, there's no reason they should have funded my entrant into that business, and I should bring some experience to the table before I have somebody else's money on the line. So for me, it was a growth strategy. And, I believe in organic growth and, growing your way into a business rather than, launching yourself into a business.
Yeah. And you get confidence along the way too. Your first one turns into a second one, third one. And then once you have, say, how big was your first multifamily apartment complex?
My first was 16 units. So it was small enough where, if you have trouble or if you fail, at least you're failing a little smaller. There's some people, I was just talking to another guy on a podcast I recorded earlier today. We were talking about someone that we both know of that, got into larger buildings a lot sooner than he should have and ended up failing. And, the project went into foreclosure. They lost investors' money. Now the lenders are coming after him. And I mean, he's going to be finished. I mean, there's no future for him in this business as a result. And it's because you're going to make mistakes in this business. There's just no way around it. I call it the rookie mistake phase of your career. And the best way to do that, in my opinion, is to do that small, make those mistakes, learn from it, and then grow as your skill, confidence, and competence grows. And then you have staying power in this business. And that's how I've managed to be in this business for 35 years without losing a nickel of investor principal, because, when I would fail with my own resources, and it would be small enough that I could recover from it.
Yeah, that's huge. Competence is huge, and putting your own self out there as a guinea pig before inviting others to play in your arena first. That's huge. And you're learning the business. You're learning property management, the operations, what it takes to run something efficiently and see it all the way through the cycle, whether it's evictions and then renovations and releasing and working with Section 8 community, just on and on and on. The experience just never stops. And if you start small and then keep getting the confidence and building up and up and up, it goes from there. Are you managing your portfolio, or are you using third-party property management? And
well, that's an interesting question, because it ties into what you were just saying about, gaining the experience and failing. And one thing that I learned early on in my career is that I was a terrible property manager. I was just too soft. I would let people, so a great example is I had this rental condo and I advertised it in the paper. I was self-managing it. I have these two girls show up to look at it. They love the unit. They're like, oh, we want to rent it. I did the credit check. I did everything the book says you're supposed to do. And then the day of move-in, we meet at the property to exchange keys for a cashier's check for the security deposit in the first month's rent. And when we arrive, they say like, oh gosh, we didn't have time to get to the bank. So, would you just take a personal check? And it's like, gee, the book says I shouldn't do that. But, these girls are good and their credit was fine. So yeah, sure. I'll make an exception this time and I'll take a personal check. Well, I mean, you can see what happened, right? I'm sure you've already guessed. The personal check bounces. I never saw a dime from them. I had to evict them when the sheriff was done evicting them because they stayed that long. The unit was trashed and it cost me thousands of dollars to put it back in the condition it was in. So I learned at that point, like, I'm not the right guy to be a property manager. So I started using a lot of third-party property management early in my career. But as we grew and scaled, we ultimately ended up being in a business I never saw myself in, which was property management. I started a property management company about 7 years ago, only to manage our own assets. Yeah. But I did that by bringing in an expert who had decades in the property management business, who had managed tens of thousands of units for institutional property owners and could bring basically a management company in a box, run this thing with an incredible team of really highly skilled people who have worked together for years. And now we are vertically integrated. We manage our own assets, but I'm not the one doing it. I have people that specialize in that field that are doing it.
Yeah, that's it's a smart move, because now you control the outcome to everything, and you can pull different levers that you couldn't pull before. I mean, it's amazing how you can tighten up expenses just by being a little bit closer to home plate. Putting other people in front of you to manage a business third party, it works until it doesn't work, and then I find out. But like myself, I'm overhearing things that I normally wouldn't hear: toilets, termites, and all the other good fun stuff. But at least I know versus not knowing, because before I just didn't know. So But very good. Let's get into syndications. Let's get into how did you know when it was time to start raising other people's money and get into your first syndication?
My first syndication was about 24 years ago when I created a fund to acquire flip houses on the courthouse steps. And I did this when it was an interesting experience because my business was starting to grow and I was funding it through various credit lines and different things. And, I wasn't able to scale much beyond the point that I already had, but I had a successful enough business where we were making good enough money that I was quitting my job. And I was in law enforcement at the time. And I put in my 2 weeks notice and I told all the guys at the station, I'm like, I put in my 2 weeks notice. I'm out of here. I'm going to be doing this house flipping thing. I'm like, oh, by the way, I rented out the room at the community center. I'm going to talk about what I'm doing with all this real estate stuff. I want all you guys to come and I'll tell you what I'm doing. So like everybody came. I mean, the room was full of all my coworkers and I gave this dog and pony show about real estate, home prices, investing, house flipping, all this stuff. And I'm like, look, I'm creating this fund. You guys can invest with me, $5,000 minimum investment, and I'll split the profits 50-50 on the houses that we buy and flip. And I'll be damned if I didn't walk out of that room with $500,000 in investment commitments. And now I joke about this all the time. I said, now I have 28 investors with guns, right? And it's because I'm in the law enforcement business, right? All my investors are cops. So I'm like, I cannot lose these people's money. The most important thing is don't lose their money. Because if I lose their money, I'm a dead man. So that turned out to be an enormously successful fund. And then just by virtue of that, people would, contact me and say, oh, hey, a friend of mine wants to invest. And then a friend of the friend wants to invest. And you start getting a lot of that. And then after I got into multifamily and I had the multifamily experience and I had so many people asking to invest with me, I'm like, well, maybe I should grow, the multifamily side more beyond just my own personal holdings and buy larger buildings and, have investors that are investing alongside me that, we can scale up the business. And so it was really a natural thing where I didn't actually have to go out and look for investors. It's like investors were coming to me and it was just time.
That's incredible. That's a great story. You got them all in a room together and told them your vision.
That's
and
it.
You sold the buy-in and it's worked out. But you also had experience and proof of concept before you took that leap. So it's you proved it to yourself. What do you see in the industry right now? Because I think that's the overarching question. You got interest rates. You got the 10-year keeps on flux. Now it's back up. What are you seeing out there?
Well, I'll start with what I saw. 2.5 years ago, I saw a very frothy market on the multifamily side. And we had about 4,000 units at the time. And I'm like, something's going on, right? It's getting really frothy. We're trying to buy stuff and we're getting outbid by millions and millions of dollars from buyers that have no experience, that are putting up 7-figure non-refundable earnest money deposits. I'm like, if this is the kind of stuff that's really going on out there, we should see if one of these people is willing to do that for one of our assets. And so we started selling and it was happening. We were getting amazing, just blow your mind type of prices with non-refundable earnest money. So I started selling and we just went on this selling campaign, sold 3/4 of the portfolio, about 3,000 multifamily units. We finished selling early 2022. And then literally the next day, it feels like interest rates started shooting up and the whole market fell apart. And stuff that we were seeing trading for $250,000 a unit was now going for, $175,000, and, prices were starting to fall, rents were starting to fall, vacancies were climbing. And I think we timed that partial exit incredibly well. And we still have 1,000 units in our portfolio, and we'd like to grow our portfolio back, but it's just not the right time. So we haven't bought anything now in 3 years, and I don't know how much longer it's going to be before we do buy something. So I haven't been doing a lot. I think this is the first time in my 35-year career I haven't been running 100 miles an hour with my hair on fire, and I'm actually noticing that I kind of like that.
Yeah, I mean, well, 1,000 units, that's still give or take. I mean, that's over $100 million worth of assets under management at least, depending on where they're at in the class. Are you all predominantly workforce housing, A, B, or C, or?
We're only doing 8 properties. My oldest property now is built in 2000. So,
Oh, wow.
we're in, kind of, we used to do 70s and 80s deals, and we got out of all of that. We sold any of those that we had. And, now we're doing mostly newer and nicer stuff. So, it's definitely more than $100,000 a unit.
Yeah.
That's for sure.
Yeah, yeah, for sure. 100%, especially, well, I mean, prices have stabilized. I mean, they're still there now. Now it's just more than anything, interest rates. What do you think? How do you feel about syndications? Because I know you brought up earlier someone who's basically doomed, which I think there's quite a bit of that out there. More than anything, because lack of experience and lack of knowing how a business works and operates. We had a lot of that. But what are your thoughts on syndications in general?
Well, you're right. We did have a lot of that. We had a lot of people that didn't understand the business. Maybe they weren't experienced. But above and beyond that, there's one other thing that we had that I think is a bigger threat to the industry, and that's just the fact that these deals weren't structured well. And so you have people that were buying at the peak of the market at peak prices with high leverage financing. Behind the high leverage financing, there's layers of other senior equity, such as, maybe there's mezzanine debt. You've got preferred sponsors who are doing split share classes with A shares and B shares. And the A shares have priority over the B shares. So the B shares, is like the lowest and last in line, which is fine if you're right behind a first lender at a low LTV. But it's not so fine if you're like third, fourth, or fifth in line behind all these other classes of senior capital in the stack. And that's really where I think we're seeing a lot of the distress in the syndication climate is, a lot of, maybe newer, lesser experienced sponsors that didn't have a deep base of investors were repurposing bridge loans, which really were designed to take an underperforming property that didn't qualify for permanent financing and allow the owner to get it to a performing asset that did qualify for permanent financing. But these sponsors were repurposing these bridge loans to use them as a crutch so they wouldn't have to raise as much equity. And then you had experienced sponsors who were trying to grow their portfolio, who really focused on unit count, AUM. And they're like, well, we can use high leverage bridge debt to raise less money per deal, which means we can buy bigger deals and more deals. And so there was a lot of that going on. Like when we were making offers and getting outbid by millions of dollars, I would ask the brokers, like, okay, out of all the other buyers, how many of them are using bridge debt? Because we're proposing to use agency debt. How many of the other buyers are using bridge debt? And in almost every case, the brokers would say all of them. And when that was happening, you're like, okay, these are really bad structures that if there's any kind of dislocation in the market, there's going to be massive distress across this portfolio. So that's what we're seeing play out now is where, okay, all of a sudden rent growth fell off. Rents actually began to decline. Interest rates went up. Property values came down. Loans are coming due. They can't refi because the value is down. The interest rates are higher. The debt service coverage doesn't qualify. And all these things are kind of coming to a head. It started happening about a year ago, and then lenders were kicking a can down the road saying like, okay, we'll give you another year because everything will be better. And now they're finding, there was just an article that came out the other day, 90% of the kick the can down the road loans are redefaulting because the problem hasn't been fixed. And so there's going to be a little bit more distress, I think, coming down the future. So, I'm just basically watching the traffic collision play out from the sidewalk. And then when everybody crashes into each other, I'll come in and sweep up the glass. And I'm perfectly happy waiting for that day to come. And I think there's a little bit of time left before that really gets here.
Yeah, it's a little bit more pain left for sure. There was one instance, one story that I'd heard. His debt went from $450,000 a month up to almost $880 because the mezz debt kicked into a higher interest rate, and it's just, man, it's brutal. You can't weather the storm. It's just that's too much, and unfortunately, like you had mentioned, the LPs get they're just bypass product, and they help make it close. A lot of them, it was their first investment, and just it's a shame. It's just, but it's one of those. This too shall pass, and then there'll be guys picking up the properties and making them perform again.
Well, chaos always breeds opportunity, right? So when
Right.
there's chaos like this and you have all this stuff going on in the marketplace and then your properties are getting foreclosed, there's distress, bankruptcies, forced sales, all these things are happening. That just it's terrible for the existing ownership group, but it creates opportunity for groups that are well positioned to be able to pick this stuff up for a reasonable basis when the market begins to recover.
Yeah, yeah, absolutely. And it's almost like you have to let everything just flush through because you can't even do anything until that happens with the property. It's got to reach a basis that makes sense, and you just can't. There's too much hanging on until that happens. Um,
That's
what
right.
are
It'll happen.
Yeah, yeah, for sure. What are some strategies that you're seeing that you're hearing about that syndicators there might be using right now? And I guess what is the what are you hearing from LPs? Are they still have an appetite for syndications, or what's your take?
Yeah, from operators, one thing I'm hearing a lot from them is like, oh, it's okay to pay a 5 cap for a property in a 6.25% interest rate environment because interest rates are going to be lower in a year or two and I can always refinance. So I'm still hearing a lot of that kind of like wishful thinking and hoping that's going to happen. I don't know how well that's going to end up playing out for people that are thinking that way. But that's the strategy I'm seeing from those who are buying. Most of the groups that are really disciplined are pencils down. We're not seeing a lot of transaction velocity. In fact, transaction volumes are down about 80% from where they peaked out, which is not surprising because the numbers just simply don't work. Now, don't get me wrong, there's a needle in every haystack, and there's buyers that are able to find a really good hidden gem, and that's great. So there is some transaction volume happening that are probably decent deals. But just as a macro level picture, like for somebody like me who would want to do, a reasonable amount of volume, don't have time to look for that many needles in that many haystacks. You want to be able to buy the haystack rather than the needle because it's just a lot less friction, and we just haven't quite gotten to that point yet.
What is the what size deals do you all typically purchase?
We're kind of in that 30 to $60 million price point is our real sweet spot.
Got it. And that's A class. There's a lot of groups that are, well, we'll say groups that are on the sidelines right now that are looking for those as well and just waiting for those needles to come out.
Yeah, this is the product type that everybody wants. I mean, right now, if you have like a reasonably priced, a deal that's newer, well located in a good market, there's going to be a lot of buyers. There's going to be multiple offers for it. It's almost just as competitive as it was like, pre-COVID or maybe even, like 21. But if you've got like 70s and 60s style product in a marginal neighborhood, it's like, good luck. It seems like nobody really wants to buy that stuff. And if they do, it's a pretty reduced basis from what sellers would expect. And, but again, like I said, that could be that needle in the haystack, right?
Yeah. I mean, it's just, there's so many variations that go into it. What would you suggest that investors look for and I guess kind of due diligence on for syndicators right now, just to be on the lookout?
Yeah, and I didn't address your question about what passive investors are saying, so that question kind of dovetails nicely into that. We're hearing from our investor base, a lot of them are asking, when's our next fund? Because they like the housing play. And fundamentally, the housing play is a sound investment strategy because everybody, needs housing. And, with a growing population, albeit slowly right now, there's always that demand for housing. So I think it's a viable strategy long term. It's just a matter of getting in at the right basis. And I think investors are still hungry for that. And I think it's going to be more so as, the 5.5% no risk money market option is going to go away if interest rates decline. And that's going to force people to look at alternatives. So I think that's a big play. But I think investors, what they're looking for is risk adjusted balance. I think that they don't want to invest in shaky structures where, there's a lot of senior equity in front of them and high leverage. I think investors are really learning that they need to manage the risk profile of the investments that they're looking at. So what questions investors should be asking are, in my opinion, right along that line. It's all about, the experience and track record of the sponsor, followed by how the deal is structured, what the financing structure looks like. And the more equity you have and the less debt you have, the less risk, also the less return, but the less risk. And then again, looking at the deal itself and the market that it's in, and seeing if there's long-term viability for that deal, and are you making the right investment in the right place at the right time?
Yeah. Do you all offer prefs on as a part? Is it a part of the share class, or is it just a general? What are your typical deal structures look like?
Our typical structure is a one equity class structure where, I'll just kind of outline what, the last deal we did was $150 million portfolio purchase. We financed it at 60% leverage from Freddie Mac. So that means 40% equity just for the down payment, plus, of course, renovation costs, closing costs, and so on. So we probably actually have like 60% equity and 40% debt if you looked at the entire stack of capital. All of that equity is one single share class. So those investors are directly behind the secured debt with Freddie Mac. We don't have any preferred equity slice. We don't have any senior share class. The investors that are in that common equity tranche get a preferred return, which means that they get all of the distributable capital, if there is any, up to the point until they reach an 8% return. After that, there's profit splits that take place that are at different hurdle tiers depending upon how high their return gets. Now, it's important to remember what a preferred return is, because a lot of people forget this whole concept. A preferred return does not mean that it's not like a loan payment. A preferred return just means exactly what I said. You get 100% of the distributable cash if there is any. Now, if there isn't any, whatever you don't get accrues and becomes due. So if the property sells later and there's undistributed, accumulated preferred return, that goes 100% to the investor until that tier is satisfied. And then after that, there's profit splits to the sponsor. But if your question is about, do we have tranches of straight preferred equity that are in senior position to our common equity, the answer to that is we don't.
No, that's a very, very clean, simple structure. And it doesn't get into the different share classes and then the profit splits. That's good. Do you all work with family offices alongside retail investors?
We do. We have family offices. We have retail investors. We've done deals with institutional LPs in the past. I don't have any right with institutional LPs right now. I actually kind of am glad I don't. I like having retail investors and family offices in our investor pool. It's a really good spot to be, I think, especially when markets are tough. Which is good. So we have a really clean structure, which is why, the 1,000 units we have left is going to survive this adverse market cycle where a lot of sponsors are finding themselves in various degrees of distress.
Yeah, no, that's huge. Very good. If you could give some advice to an aspiring real estate investor or entrepreneur looking to get into real estate, what could you give them?
I think the best advice is it's easier to lose $1 million than to make $1 million. So really think about the risk profile of what you're doing. And I think this applies whether you're a syndication sponsor or you're a passive syndication LP investor. Think about the risk profile of the investment that you're contemplating, because it really does make a difference. And also think about, is this the right investment in the right place at the right time? Because it's really easy to get into a real estate deal, but it's really difficult to get out of a troubled real estate deal. And, I've got experience in that. I've been doing this for a long time. I've been through a lot of market cycles, and I've had assets that thankfully were not in investor owned entities, but in my own entities where the deals weren't going well. And I've had properties where I've had to hold them 20 years to be able to get out of them. And it's a long grind to get through that. So, just be very selective and realize that this is a little bit like a marriage, whether you're investing in real estate directly or you're investing in a passive syndication with a sponsor. It's a marriage either way, that you're wedded to this hard asset that you have to do something with. You can't sell it in 5 seconds like you can your mutual fund shares, your common stock, your money market funds. You can't do that. This takes a while to get out of them. So make sure that when you're getting into them, it's something that you're comfortable with.
Yeah. What do you see in 2025 with the market and interest rates?
Well, market-wise, we're starting to see reduced construction starts. Construction starts are down by 50%, which is good. That means less inventory coming online. And the inventory that's coming online has been what's been a major headwind towards rent growth over the last few years, because construction pipeline has been at record highs. After COVID, everybody started building and construction went to record highs. And we're still seeing inventory delivery, though, because a lot of these in progress construction projects were taking longer to complete. And that means that this stuff is taking longer to deliver. So there's this overhang of new supply that's continuing to come online. I think we're going to see that going into 25 as well. I think a lot of people predicted that would be over with in 24. There was this whole, the saying was survive till 25. And, if they could just get through 24, then there's going to be less inventory, which is going to mean supply demand imbalance, which is going to mean rent growth, which is going to mean everybody's going to be happy. I don't think it's going to quite play out that way. I think it's going to slowly happen through 25. I think 26 might be our year. Maybe we should change the slogan to "It's fixed in 26." I don't know. But, I think then we'll start to see, less completions coming online, less starts. There will be a gap in inventory for a few years, which I think will allow some rent growth to come back. Interest rates will hopefully stabilize, or we're going to get used to whatever interest rates are. And if interest rates are permanently at the level they're at now, pricing is going to ultimately have to come in line to that interest rate reality, and we can get a better basis. I think if I were to be predicting when our next multifamily investment is going to be, it's definitely not going to be in 24. It could be in 25 if I find this needle in the haystack. But 26 might be looking a little bit more promising. I think maybe 26 and 27 might be when we start to see this turn around.
Cool. Awesome. Brian, we definitely appreciate you coming on the show today. If you could let the listeners know how they can reach out to you, learn more about your company, and possibly invest with you when you'll start buying again.
Yeah, that sounds great. So they can reach us at our website, which is praxcap.com. It's short for Praxis Capital. The web address is spelled praxcap.com. You can also follow me on Instagram at Investor Brian Burke, or you could check out my book, The Hands-Off Investor, which is written for passive investors to learn how to invest in passive real estate investments at biggerpockets.com/syndication book.
Awesome. Brian, definitely appreciate your time. Look forward to following you, and we'll talk soon. Thank you.
Thanks for having me.